Hello friends, I'm Sonjai Kumar and welcome to my channel for another video. This time I'm bringing lessons from the failure of the Silicon Valley Bank. In this video we'll see that what were the causes of the failures of the Silicon Valley Bank and what we can learn so that this can be applied in another situation where such risk management event happens. So let's see that what was the short story. So so what happened that when the economic factor hit the tech sector, tech means the IT tech sector, many bank customer withdrew money as venture capital started withdrawing. The Silicon Valley Bank did not have the cash on hand to liquidate these deposits because it was tied up in a long-term investment. It started selling its bond at a significant loss, which caused distress to the customer and the investor. This is a very short story, and you must be knowing by now what has happened to the Silicon Valley Bank. Now there is a word of caution here I have given that it is always easy to look the things in a hindsight, but it is difficult when the event is happening or it is event likely to happen, and that's what the risk management is all about. So the lessons or the learnings from the past need to be applied. It's always easy to analyze the past risk management events, but those need to be understood and those techniques should be applied in the future. That's the word of caution is. So let's see that what happened and where were the failures. The first failure that happened was the lack of anticipation of risk. The speed with which the depositor withdrew the money from the bank. It is important to understand that what is the velocity of the risk, because at times risk crystallize very fast, and for any institution it becomes very important and they should be ready for that the risk can approach to them very quickly. And this is what exactly happened with this bank, that the cash withdrew within few days time, and as a result of that the liquidity risk crystallized. The next learning is that the lack of dynamic risk management. The lack of dynamic risk management means that it is not that the risk management is done once and it is left out. Many organizations may think that they are in a hedged risk management position for a particular economic scenario. But as the economic scenario changes, the risk position turns upside down. This was the case with this Silicon Valley Bank, that they had invested their money when the interest rate scenario was low, and they had invested the money in a long-term assets held to maturity in the government bond. Now change in the economic scenario. So most developed countries had a low interest rate regime before the Russia-Ukraine war. So remember the days of COVID when there was an economic downturn around the world. The world was struggling with a low interest rate scenario. And once the Russia-Ukraine war hit, the inflation increased. And as a result, to manage the inflation, the different central banks started increasing the interest rate. And perhaps organization like Silicon Valley Bank was perhaps not ready for that. Assets value and interest rate have inverse relationship. The asset value and the interest rate have inverse relationship because as a result after the increase in the interest rate, the value of assets fell down. If the interest rate is going down, the value of assets will increase. If the interest rate is increasing, the value of assets will come down. Another was, as we said, the Silicon Valley Bank had the investment philosophy. The bank had invested in many long-term assets in the government bond held to maturity. What is mean by held to maturity? That once they have purchased the bond, then if the bond is of 20 years, they will keep it for 20 years time. And that's what is held to maturity. And this was a scenario when the interest rate low. Such held to maturity scenario generally gives you a better return. And investment in the government bond is a safe investment. So from the investment point of view, if we look at from the Silicon Valley Bank, it was not a bad investment, because they invested in the long assets. They had invested in the safe assets. So they had investment philosophy. But perhaps they were not ready for the change in the interest rate. And for that, one need to do a dynamic hedging or the dynamic duration matching scenario. So what happened, that the reduction in the value of assets. So once the interest rate increased, once the Fed increased the interest rate, the value of assets started coming down, which created a mismatch between the assets and liabilities. So what happened, that the value of assets gone down and the value of liabilities will also come down, right? But not to that extent, and that depends upon the duration of assets and liabilities. Once you have invested in a long-term assets, then the duration of asset has increased, and maybe that the duration of liability is shorter. So what will happen, that once the interest rate has changed, the fall in the asset value is much more than the fall in the liabilities value. And what happened, that the withdrawal increased. Once the withdrawal increased, the liquidity risk triggered, because even if you sell all your assets, which is now held to the maturity, you're not going to match the liquidity scenario where all the investors are going to withdraw the money. And that was the challenge. It was actually hitting the both sides of the balance sheet. On a one side, because of the change in the interest rate, it was assets was being hit. On the other hand, when the withdrawal increased, it also hit the liability side. And this was perhaps a rare scenario. The bank might not have imagined that such scenario simultaneously occur at the same point of time and would result in the collapse of a bank. And that's what it is, the tail risk. This is what the tail risk is, that where the probability of happening of the event is very small, but the impact is very high. And that's what the risk management is all about. The lack of liquid fund, despite having assets held to maturity, makes the bank insolvent. So what need to be done? Need to have a diversified portfolio. In hindsight, the investment philosophy of investing most of the assets in HTM was questionable. Yes, it is questionable, because one need to have a diversified portfolio so that the impact on a portfolio is not so much if there is a change in the interest rate. Also, the dynamic duration matching. It is also important that it is not that the duration matching is done once. This need to be done all the time. This need to be done. They also need to create a different scenarios, so that once the scenario is being created for the different interest rate, one can know in advance that where the where the company, where the bank is going to get burst. And that's where the scenario analysis or stress testing helps. We don't know whether such activity happened or not. Another point was bank was without the chief risk officer. The bank was without the chief risk officer for over last 8 months prior to the collapse. The presence of CRO helped in providing oversight of the risk as a key role. In an organization, particularly I would say in any organization, the different CXOs has got a different role. CRO is the only person in the organization who looks at the risk. And once that head of the function is not there, this may create a challenging situation, that whether a proper oversight is being given or not. That is the key question, because the risk identification or highlighting the risk to the management and to the board is one of the key roles of the chief risk officer. And in such a critical time when there is a change in the economic scenario, the CRO is not there. Maybe the bank would be thinking that they will be appointing it later on, but this can prove a very costly affair. So in summary, what are the things that we can learn from the collapse of the Silicon Valley Bank? Lack of anticipation of the tail risk. The risk was not anticipated, and perhaps they had never imagined that the assets and the liability will be hit simultaneously. This is a general human thinking, and in my working life also, many of the people have discussed or talked in this fashion, that such and such scenario are unlikely to happen. The people make an assumption that such scenarios are unlikely to happen, and when the speed of the scenario is very fast, it does not give you time to basically take the corrective action. Lack of dynamic risk management. This is, I think, a motherhood statement, that risk management is not to be done once. This need to be done all the time. Otherwise, one may think, the board may be thinking, senior management may be thinking that yes, we are doing a risk management, but that is only good for some point of time or some particular scenarios. And in this changing dynamic world, this changes very fast. Lack of foresight. There's a need to have a foresight. As I said, need to develop some economic scenarios, some, not necessarily just the economic scenario, but also the demographic scenario, the political scenarios, the stress testing, how we can foresee the future, and how we can take the action now. Not action, but I would say we plan for the action if the risk happens in the future. Questionable investment philosophy. Yes, having it was a good investment philosophy when the interest rate was low. The investment was in the safe assets. The investment was held to maturity in the in the long term assets. But when the situation changed, it required a change in the investment. Lack of assets and liability matching. One need to do a dynamically asset liability matching, especially when in the financial institution. Similarly, one need to do the dynamic duration matching. These are one of the same things. It's a different way that how do you do it. The dynamic asset liability matching you can do by the cash flow matching also. Liquidity risk was not well managed. Yes, we saw that liquidity risk at times, uh, people may think of that it is the solvency risk that is more important. But even the 2008 economic crisis happened due to the liquidity risk, because when the money dries up, it becomes very difficult to bring the cash and keep the bank or the financial institution running. Appointment of the chief risk officer. This is another importance because Chief risk officers' primary role is to look at the risk. It is their role to provide an oversight onto the risk. They are the only people out of the entire organization that look at the risk, and he or she should not be ignored. So in summary, these are 8, the lessons that we can learn from it. And many of the lessons we have to take it not only in the banking industry, but in any of the places where we are doing the risk management. So this is what I have from my side. Thanks a lot. You can like and subscribe to my channel, and you can also share your comments and what you would like to hear next time. I will definitely bring the next video. Thanks and goodbye till then.